welcome back to my YouTube channel. My name is Sakshi and this is the part 2 of what type of investor are you, and in this video we are going to talk about investor based upon their risk appetites. So let me know in the comment section if you have any doubts regarding the video, and hope you guys like this video, and so let's get started. Investors are usually classified into three main categories based upon how much risk they can tolerate, right? So they include aggressive investors, conservative investors, and moderate investors. Knowing the risk tolerance level helps investors plan their entire portfolio, and this will drive how they invest and get benefited in the future in terms of their returns. So if you are an aggressive investor or a conservative investor, the return you are getting is most important to you, and what type of investor you can define your returns in a really good way. Next, we are going to talk about risk tolerance, right? So, what is risk tolerant? It is the amount of loss that an investor is willing to accept while making an investing choice. So, if somebody is coming in the stock market, so there is certain amount of risk that one investor can take and is willing to take. So, this is the criteria, and this is what we call as risk tolerance. So obviously, knowing one's risk tolerance level is an utmost essential important thing for investors in planning their whole portfolio. Okay, so and this can severely influence how they invest, right? For example, if a person risk tolerance is low, investment will be undertaken cautiously, right? But with more low risk investments and fewer high risk ventures. So depending upon what type of investor you are, if you are an aggressive investor, then your risk tolerance level will be very high, right? So this tolerance level we have categorized into 5 parts. So first thing is time frame. So what this means that if anything occurs in between of your investing, then how this will impact your overall portfolio, right? So next is financial goals. So what is your goal in for the future, right? If your goal is to buy a house or go for a trip or for marriage or anything, so how much, what type of goal you have, how much amount you will be required to achieve that goal, that depends on the how much risk you can take. Either you can take more risk to achieve that goal in less time frame, right? And the age, this is the very important factor that can seriously define how much risk you can take. So suppose if you are a teenager, then you can take the utmost risk. But if you are near your retirement, then I don't think anybody can take as much risk as you can take in your early 20s or early 30s, right? Next is investors degree of comfort. So if many of us listen from our neighbors, family members, so this also impact our risk tolerance level. So how much comfortable we are taking that amount of risk, that losing that amount of money, so that comfort is also required. Next is the size of portfolio. If you are having a huge chunk of portfolio, huge chunk of stocks in your portfolio, then your risk tolerance level would be high, right? As compared to if you are very early investor, then you will be taking less risk, your portfolio size would be small, you are learning in the market. So these 5 factors can seriously define your risk tolerance level. And if you are somebody who wants to know your risk tolerance, then you should work on these 5 things and number your priorities and least priority level, and on the basis of that you can define how much risk you should take in the market. Moving forward, on the basis of the risk appetite, we have first investors, which is aggressive investors. So who are they? They are ready to take more risk and accept sustainable short-term volatility in the market performance on an annualized basis. What does this mean? This means is that they have that risk appetite in themselves, and they are ready to take short term volatility in their portfolio, and they can buy or sell a stocks on the basis very quickly as compared to moderate or conservative investors. So they don't think or waste their time on thinking that or holding the stock. They are very aggressive on their decision making skills. So we have categorized aggressive investors on the basis of growth, risk, and volatility. So first, talking about growth, so they aspire for significant market growth, typically exceeding long-term investors' market performance. So they want to exceed what the long-term investors gain in their portfolio. So they aggressively buy, sell stocks on a regular basis. Second is risk. So as we have read that they are more risk taker, so they are ready to take more risk to get more returns. So in the stock market, everybody should remember that if you take more risk, you will get more return, and this is the truth. If you take higher risk, you will get higher return. Third is volatility. So likewise, they are looking for a speedy returns on their investment, and they are also called day traders. So they are very they really want to ready to take more risk, and they are ready to take a substantial short term volatility. So it's okay for them to see their portfolio in red or greens in on every alternate days. So also, like individual stocks and mutual funds are popular equity investment for aggressive investors. So they majorly invest either in individual stocks or in the mutual funds. Next is moderate investor. So as and when we compare it with the aggressive risk investors, they are less risk tolerant. They are likely to take less risk as compared to the aggressive investors. Also, they are significantly less likely to accept changes in their portfolio balance. So they really don't buy or sell on a regular basis. They may do in a weekly or a monthly or maybe on a quarterly basis. Also, when we talk about individual who need like money in 3 to 6 years, or who want their steady income return, they are best likely to be an moderate investors. Or a moderately cautious portfolio, right, is frequently heavier on individual bonds, which are investors who invest more on individual bonds or bonds on mutual funds, and they can expect yearly returns. So on the growth basis, if you can say that 6 to 8% they can expect return. And a risk, as they are less likely to take risk, but they are ready to take some amount of risk for their good amount of return. And when we talk about a volatility, so they may change their portfolio stocks on a weekly or maybe on a monthly or quarterly basis, not on a regular basis. So they don't buy or sell on a regular basis. Also, the dividend income is the best source of income for them, and they are best likely to earn income from their assets in the form of dividends on a weekly or an annual basis. So the next is conservative investor. So they are often individual with a short term aim, less than 3 years, or those who are in the retirement age, or they want a consistent income return for their future. So people who investors who are conservative, they are very less likely to take risk. They are more conservative. They want their money to be in the safe hands, and they don't want to take any like unknown step for their return. Also, their portfolio shift away from equity investments, and they're likely to invest more in the debt market. So they want their in preservative investments such as REITs, right, real estates, and individual bonds, bond funds, maybe in a municipal funds and annuities. So these assets are not meant to create significant growth in their portfolio. They cannot see higher growth in their portfolio, as they have invested in debt and they have not invested in the equity, right? So as they are less likely to take risk, so their return would be, as and when we compare it with the moderate or aggressive investor, their return would be low. If we are expecting moderate 6 to 8% return, and then in the conservative investors we can expect 2 to 3 or maybe 4% of return. So these assets, where what I have just told you, are not meant to create significant growth in their portfolio, but rather to provide income. So they don't see their portfolio to be more volatile, right, because they want a steady income, and which means that they want their money to get protected and the main balance during the investor expected life span. So they want their money to be in a safer hands. They don't want their money to have to be in the market for play with their in the equity market. So they want their money to be in the safer hands and to get a regular income stream in the future. So what is my point of view? So we have learned that there are three type of investors in the stock market: aggressive, moderate and conservative. What I personally feel is every individual has all these three qualities and they use it in a different time frame, in a different age. So if suppose if you are a person who are in their mid 20s or in early 20s, right, so you would be an aggressive investor. You would try to buy, sell and do trading on a regular basis, right? So is there anything which is wrong in this? No, there is nothing wrong in this, but the only thing that you should remember is you should keep it in a percentage wise. If so, suppose if you are in your early 20s, then you should keep 80% be an aggressive investors and 20% you should keep investing in debt fund, right? So you will keep getting returns. Maybe it will definitely be a less return as when we compare it with the aggressive investors, but you will have your money safe in this, right? And suppose now the second is a moderate investor. So in this, if you are married, you have children, then you will try to keep your money, little money is safe, and you will try to take less risk. No matter how much return you will get, you will try, you want that if there is any emergency, then you want your money to be in hand at a sooner time, right? So you in that time frame, you may want 50% of your money in debt and 50% in equity. You want to experiment, you want to invest in stock, you want to invest in bonds, mutual funds, right? And in this and after, suppose if you are in your early if you are going in your 60s or maybe 70s, well, this is a retirement age, right? So you never want your money to be in equity market, right? Majority of the retirement people want their regular income. So what they do is they maybe do 10 to 20% of their money in the debt and in 10 to 20 in equity. So they don't want to buy any more stocks. They just want, the only thing they want is dividend and regular dividends. Whatever the stocks they have bought in their aggressive time period, in their moderate time period, they want the regular dividends from it, regular income stream, right? So this is the summary of how age can really define, or if there is an emergency, how time frame can really define what type of investor you are. It is never possible to be the same aggressive investors at the age of 70, and it is not logical even that if you are 60 or 70 you are daily trading, buying and selling. There are number of things that keep on going. So as an individual, you should be open for change, open for being aggressive at some point of time, be a moderate person, and be an conservative investor at some point of your time, and you can really enjoy the returns as you grow older, and you can keep getting good returns, dividend income on a regular basis. So yes, so this is what my opinion is. If anything that you guys want to add up, you can really comment down in the below section, and and we can chat there and see what type of investor can really help you in what age time frame you are in. Okay, thank you.